Hi, a very good afternoon to all of you, and welcome to FintEdu's webinar on the recently released UAE transfer pricing disclosure form. So, as many of you are aware, the deadline for filing the CT return, which was originally set for 30th of September, has been extended to 31st December 2024 now. And this extension includes provisions for submitting details on transactions with related parties and connected persons. To guide us through this important topic, we are pleased to have Ajit Jain, who is a partner at AJMS Global with us today for this. So thank you everyone again for joining in, and let's get started. Ajit, over to you, please.
Yeah, thank you, Anu, and thanks for this opportunity to present on a very important topic of UAE transfer pricing disclosure form. So in this session, what we are going to discuss is the broad overview of this form, what the form contains, and what are the issues related to the form. But my major focus would be some of the practical aspect. Just to give, before we start, so just to give you my quick introduction, Anu has already introduced. I've worked across India, Middle East, and UK, and I've seen countries like India and KSA where there's a significant amount of but also related the practical aspect, and those practical aspects are very important, especially from an audit perspective. Generally, transfer pricing is seen only from a compliance perspective, and we always want to do the compliance before the timeline. But the broader aspect of the transfer pricing is the audit part. And when audit comes, the first document the tax authority see is the disclosure form. And I always wanted to see this disclosure form as a global tier 4 documents. We are also always hearing about the 3-tier TP documentation, but I see TP disclosure form is equally important. And the biggest challenge in today's time is the TP disclosure requirements is there in number of countries, but there's an inconsistency in terms of the approach. Like in KSA, there's a requirement of transfer pricing affidavit. There's a requirement of audit in some other countries. So there's a different inconsistent approach, but we'll discuss on that also. But as I mentioned, when we talk about disclosure form, it's not only about the compliance, it's also about the bringing efficiencies in the system, how we manage our transfer pricing policy, and also to be audit ready from the day one. Because as I mentioned, the tax authority, the first thing they see is the disclosure form. So it is the foundation for any efficient transfer pricing compliance and bring overall efficiencies. Now, before we start to the transfer pricing disclosure form, let's talk about the broad UAE transfer pricing framework. So it is the transfer pricing is a part of the corporate tax law effective from 1st June 2023. We all know about it. The regulations broadly follows the OECD transfer pricing guideline. When we talk about the key components of the regulations, there's arm's length principle, Article 34, 35 and 36 talking about related party and connected person. Then we have Article 55, which is talking about transfer pricing documentation, including the disclosure form. And then over and above, there is a transfer pricing guidelines giving the guidance on various aspects of the transfer pricing regulations. So this is the broad overview. So far, we had the clarity about the transfer pricing documentation, local file, master file, but now the UAE TP, the FTA has published the TP disclosure form, and that is also part of the transfer pricing documentation. Let's understand first, because when we talk about the disclosure form, it is important to understand first to whom the TP regulations are applicable. Then only we would be able to accurately fill the form and meet the requirement as per the law. The transfer pricing regulations are applicable to the associated person, which means the juridical person and the natural person, and it is basically applicable for the transactions and arrangement between related party and connected person. At many places, we generally talk about, when we talk about the transfer pricing, we talk about transaction between related party. But it is very important to understand that the regulations and the guide, wherever they are talking about transaction, they're also talking about the arrangement. And I think this is one of the smartest move by the FTA, because if you see the OECD guidelines, they are not specifically talking about arrangement everywhere. But given that there has been a significant amount of litigation happen in the world on transfer pricing, and there are some arrangement which are were not part of the regulations. Now it is part of the regulation. So we'll talk about more about what could be the arrangement. So transaction and arrangement between related parties, those needs to be part of the transfer pricing documentation and the disclosure form. Transfer pricing regulation applicable to all the entities. Okay, so regulations, all the entities, including the exempted entities claiming small business relief. So there's no confusion about it. The regulations are applicable to all the taxable person, whether it is small entities claiming small business relief or qualifying free zone entities. It is applicable to all the entities. But the transfer pricing documentation is not applicable to exempted entities and entities claiming small business relief. So just to summarize this, when it comes to if you can see on the screen, when it comes to the applicability of the TP regulations, the arm's length principle, which is there in the Article 34, it is applicable to all the entities. Even if there is a transaction between the two qualifying free zone entities or free zone mainland, the arm's length principle is applicable. The transaction needs to be at arm's length. Even in the tax group also, we'll talk about tax group, the arm's length principle is applicable. Now, documentation, as I mentioned, the local file and master file, these are exempted specifically in the guide for exempted entities and the entities claiming small business relief. So before we talk about the disclosure form, we should have the clarity that to whom these regulations are applicable, and then we would be able to identify appropriately the related parties and the connected persons. Now let's talk about in very brief. So the objective of today's session is not to talk about who are the related parties in detail, who are the connected person, but it is very important to give an overview that which are the entities which are covered in the Article 35 as related parties. Now we all know that it is a transaction and arrangement between the related parties. Now, who are the related parties? Now, related parties, broadly, there are two criteria. One is the ownership interest, more 50% or more, and ownership can be direct or indirect. It can be individually with the other entity or jointly with other related party. So this can be the ownership interest. So as I mentioned, the focus is on disclosure form and practical aspect. So I'll not go into this part because this can be a separate session about ownership and various scenarios. But just to summarize that it is an ownership interest and it is not only direct, it can be direct, indirect, individually or jointly with related parties. The second aspect is the control. So this makes the related party definition very broad and wide. And similar to ownership interest, it can be directly, indirectly, or individually, jointly. And control can be in the form of voting rights or composition of the board of directors, decision making related to board of directors, profit entitlement like to third parties. If one third entity is basically providing technology to another entity and agreeing for 50% more of the profit, so that profit entitlement can make two third party related parties. Then significant influence like management support, strategic services, decision making. Even if there is no ownership interest, two entities can be related parties. So this is the broad overview of the Article 35. See, in Article 35, these are the broad things. Other than that, there is one more section which I have not covered here, is the permanent establishment and trust. So if PE also, then also it covers under the Article 35. So there's a transaction arrangement needs to be there. It should be between related party. We discuss which entities can be related party. Then the transaction needs to be disclosed in the disclosure form. Now comes to the payment to connected person. Now this is a kind of a unique provisions introduced in the UAE TP regulations because there is no tax in the hands of individual, and there could be a possibility of base erosion because of the higher deduction of the payments which is made to the connected person. Now, when we talk about the connected persons, there are basically two requirements. The one is that any payment made to the connected person is not deductible. The first thing is that if it is not occurred wholly and exclusively for the business. So this is the first requirement, and it is and not or, and it is not at market value arm's length value. Now, many times we talk about that how to benchmark these transactions, this payment to connected person. This question comes to me a lot of time. I think before going to that, it is very important to understand whether this expense is made for the wholly and exclusively for the business or not. And then we need to see whether it is at arm's length considering the market value. Now, who are the connected person? Connected person can be individuals, direct or indirect ownership, the first type of people. Second is the director or officer. Now, officer is not defined in the law. Officer can be a broad term. A general manager can be an officer, a VP or a business head can be an officer. But if we talk about the intent of the law, a practical approach can be taken. A person who is basically have the significant or decision making power can be considered as an officer. So this is very important to evaluate while when identifying who are the connected person. Now the other than these people, related party of these director officer can also be related person. Giving you example, a company is making payment to the spouse of the owner for the interior designing services which spouse has provided. So that person, that transaction also can be a connected person because the payment is made to the. So what we were talking about the disclosure form, and there are three sections, and the related party schedule is about article 35, connected person is article 36, and then there are documentation requirements. We'll talk each of these schedule and related issues, but broadly if you see this related party schedules, like any other country's TP disclosure form, we have related party name, country, tax registration number, type of transactions, transaction value, TP method, and the arm's length value, and the tax adjustment. So this is how. Now, one of the unique thing which UAE TP regulation introduced is tax adjustment in the TP disclosure form itself. So if you see any other countries TP disclosure form, generally the adjustment part is not part of the disclosure form. It's done separately in the tax return. So here, if you see, if the value of the transaction is 100 and your arm's length value is like your total transaction value in the books is 100 and your arm's length value is more, then there could be tax adjustment you need to show in the disclosure form itself at the related party schedule. Similar to the connected person, similar connected person name, TRN number if available, type of whether it is payments or benefit. Now this is very important to talk about when we talk about the connected person, is that when we talk about the this section article 36, we always talk about payment to connected person. The term is payment or benefit. So even if some benefit is provided, let's say a villa is provided to the by the company to the owner, that is benefit, so that also covered here. So payments or benefit, and then detailed description, value of the transactions, market value means the arm's length value, and the tax adjustment. So the adjustment will be your value of the payment and the market value. The difference is the tax adjustment. So we will discuss what are the issues in this schedule and what are the possibilities and whether we can get clarity from FTA or not. So we'll discuss all these things. The third part is the documentation requirement, broadly local file, master file, and the financial statement. Now, surprisingly, if you read the law requires that master file and local file needs to be maintained, but in the disclosure form, they ask us to attach. However, there's a section where we can add reasons for not attaching. See, for TP documentation is not applicable to all the entities. If you are not crossing below, if you are not crossing 200 million revenue threshold, or your consolidated revenue is not crossing 3.1, or you are an entity is claiming small business relief, all these scenarios, local file, master file not applicable. So no need to attach, but a reason can be mentioned in the disclosure form. Now, this is the broad. These are the three sections in the disclosure form, and we'll discuss in the subsequent slide each of these section in detail, that what kind of information is we need to put and what are the issues and challenges. Now, the TP disclosure form, if we talk about the objective is the ensure compliance. The moment we fill all the details correctly, it ensures that the kind of details about the related party transactions and ensure the consistency with the local file and master file also. So this is a very, very important form to ensure that all your related party transactions are disclosed in the form appropriately, accurately, and the arm's length analysis is also to be done before we submit this form. Now, as you can see in the form, they have requested for the local file and master file. It means that before we submit this form, we need to have a arm's length analysis in place. I have seen other countries where the disclosure form the arm's length analysis is required. But in this case, specifically, there's a section of TP adjustment. Specifically, there's a section where we need to attach the local file and master file. This makes the entire scene more complex, because even before the submission of the disclosure form, the local file needs to be prepared and arm's length analysis needs to be done, because the disclosure form require us to select the transfer pricing method, and we need to determine the arm's length price. That is very important. So this is very important, so that from a TP policy perspective also, some cases what happens is, I have seen where TP documentation is not to be submitted with the tax return, and that's where some taxpayer might take an approach that my profitability is very healthy, so I don't need to be I'm not concerned about it, and I can submit the disclosure at this point of time, and we can prepare the local file later on. But in specifically, when we talk about the UAE TP regulations, the UAE TP disclosure form, this is very important that before this disclosure form, arm's length analysis needs to be done to ensure there's a entire analysis made, and there should not be any issue when it comes to the book value and an arm's length value. Also, the risk assessment part, when it comes to the disclosure form, FTA has given the detailed disclosure form along with the section on the TP adjustment. Now, this is very important for the taxpayer to evaluate the transaction from a risk perspective. If the policy is not aligned with the arm's length price, or there can be some possibility of adjustment, this can be evaluated. This needs to be evaluated before we file the disclosure form. Taking the example, I am a limited risk distributor earning 2 to 3% margin, but when we do the arm's length analysis, we and do the function analysis, we came to know that the entity is not a limited risk distributor. It is more than a limited risk distributor, should be entitled to more or in not 2-3% margin, but more margin based on the function analysis. So this is a matter of contract versus conduct. In that scenario, also from a TP disclosure perspective, it is very important to understand the business in very, very detail, because as I mentioned, there's a section of transaction value and the arm's length price and the adjustment. So this is a very important exercise. And before we do that, we need to be ready with the function analysis, economic analysis, and complete analysis to ensure that the whatever transactions we are putting into, whatever the methods we are selecting, characterization we are adopting, it is in line with the actual substance, and disclosure form should be aligned with the local file, and there should not be any inconsistencies. I have seen cases specifically with the tax authorities where there are that whatever disclosed in the disclosure form and the local file is not consistent, and that raise a query before issue before the tax authority, and tax authority has started scrutinizing the transactions from various perspectives. So this is very important. And then the overall transparency perspective, disclosure form is important. Data collections. Now, as the local file is required at the time of disclosure form, this actually reduces the overall duplications, because in other countries where local file needs to be maintained, so like if we go by the law, it is required to be maintained, but if we go by the disclosure form, it needs to be attached. And I would say this overall reduces the overall duplication in the work, because when we do the analysis from a TP disclosure perspective, we need to do the complete analysis, review all the data, reconcile with the financials, lists and agreements, everything. So this actually bring overall efficiencies, because there will not be any duplication when we do the analysis for the disclosure form, and when we do the analysis for the local file and the arm's length analysis. So this is a very, very important point to which actually help us in avoiding any type of duplication in the overall analysis. This disclosure form, as I mentioned, is very, very important for the taxpayer and tax authority. For the tax authority, it helps in audit selections. FTA will see first the transactions, what kind of transactions are there, whether the taxpayer has done any self-adjustment. Interestingly, or I would say I surprised in the disclosure form. There's no sections on shareholding or the kind of how the related parties transactions are identified. Ideally, if you see other countries' disclosure form, there's a separate section on it, but it is not there in this disclosure form. But yeah, from a transaction perspective, tax authority may identify the value of the transactions, the kind of methods which is selected for the transactions, and also the volume. From that, the tax authority may select any transactions and initiate the scrutiny. But it is very, very important. The backup documentation is very important. The local file, master file, and other supporting documents. So even if there's a query, this can be negotiated and discussed with the tax authority. It overall streamline the disclosure form helps in streamlining the overall documentation. As I mentioned, the local file and the disclosure form needs to be aligned. And once it is aligned, it brings a level of transparency and also trust with the tax authorities, because if there's an inconsistency, this can create an issue. And the resource, allocations, it helps focusing on FTAs in high risk transactions. Which are the high risk transactions? So if the country is doing transaction with the low tax jurisdictions, so let's say now Bahrain has introduced the tax, there was no tax in Bahrain, or like any other country where there's no tax. If there's a transaction with that country, the tax authority can identify, because in the disclosure form, there's a section where one need to select the country of residence of the related party. So there can be various ways the tax authorities can look into and start initiating the scrutiny. And again, the self-assessment also for the taxpayer. So overall, if you see the TP disclosure form, this is not only a compliance-driven form, it is I would say, a form for the risk assessment, not only for the tax authorities, but the taxpayer also, because at the time of disclosure form, local file and all other documents need to be attached. And before submitting this, such entire analysis needs to be performed to ensure that the transaction is at arm's length and appropriate documentation has been maintained. So if we talk about this disclosure form, the features, we already discussed that there are 3 sections: related party schedule, connected person, and documentation requirement. But there are some specific features. So first I'll talk about this is embedded to the original corporate tax return, not separate filing. And there's a strategic activation. So you will not be able to see this disclosure form while going onto the FTA site as it is. If in any of your client or on your company, if the due date is activated, like 31st December 2024, it is now the due date is activated, it is now extended. For those companies, you would be able to see the disclosure form along with the tax return. So there's a strategic activation. As and when the company's due date will come closer, you will find the TP disclosure form. So this TP disclosure form to be filed along with the tax return, and due date is 9 months from the end of the tax period. There are penalties, no specific penalties from a transfer pricing perspective, but similar to what is there in the tax penalties. And we already discussed the scope applies to related parties and the connected person. And one more thing, which is very important, if you see the law and the guide, they specifically talk about materiality threshold for the disclosure form. That certain material transactions requires the filing in the disclosure form, but surprisingly, in the entire disclosure form, there's no such things, no feature, no discussion about the materiality. We may get clarity or may get some threshold, but as on today, if we see the disclosure form, there's no materiality threshold. And even if there's a transaction of 180, one need to report in the disclosure form for the tax period. So this is the broad features about these 3 sections and why the TP disclosure form is just not a compliance document. It's a very strategic, I would say, very strategic document, and the importance is increased because the local file needs to be attached along with it. So the entire analysis to be done in advance. Now, talking about the disclosure form, first page. So this is the first page of the disclosure form. This is a summary of one need to select whether the transaction is with related parties or connected person. So if you select yes, then your schedule for the related party and the connected person will be activated. And below that, there is a section where the description of the adjustment is mentioned. It is a summary of adjustment. So in your disclosure form for related party schedule, if you make any adjustment, like your book value and arm's length value is different, and there is a adjustment, this overall adjustment will be reflected in the first page. And so this is the overall summary for the related party and the connected person, talking about all the transaction, summary of the transaction and the adjustment. Now coming to the disclosure form, the second page about the related party schedule, which article 35, the related party, not the connected person. That is basically talking about the name of the related party, the transaction type, the tax residence, gross total income, gross income, the basically the arm's length value, transaction value, and adjustment. So this is the summary. Now, how this summary is coming up? This summary is coming up from this separate insertion we have to do for each related party transaction, where we need to put into the name of related party, the tax residence, it can be local entity or outside, gross income, the arm's length value, and the transaction type. Now let's discuss this part importantly. This section is asking about the gross income, not the net. Okay, so there's a sales to related party. So the gross value needs to be reported. Now I'm a bit surprised because generally we need to report the net sales after discount and all. But here, if we go by the disclosure form, we need to disclose the gross sales. In some cases, this might not reflect the actual substance of the transaction because discount is very important to consider. Now, the question is, do we need to report discounts separately in the expense side? That is something we need to see. But the point is that the gross income we need to see. Talking about the transaction type, so there are different transactions. There can be goods, services, intellectual property, interest, assets, liabilities, and others. See, in any transfer pricing arrangement or transaction, there are these type of broad transactions. Either there can be goods or services or IP or interest on loan, assets. Now, there is a liability. Surprisingly, they have included. Liability can be like in terms of the loan, or there can be contingent liability also. While that liability will not have a direct impact on the P&L, because if we talk about the loan, the underlying transaction is the P&L, not the interest, not the loan. And when the underlying transaction is interest, there is a separate category for the interest. So they have included the liabilities. There can be payables, there can be loan. There is a section of others also. Others can be, let's say there's a reimbursement, cost to cost reimbursement. There can be like some other transaction in the nature of cost contribution arrangement, which is may not be part of this. So there can be various scenarios which other the transactions are not coming into these categories, may come into the other sections. So these are the broad transaction type. Now, then comes to the transfer pricing methods. Now, there are 5 methods we all know, but then we can also consider any other method also as per the guide. But surprisingly, the option to select any other method is not there in the disclosure form. So say for example, I have purchased the machinery, very unique machinery. I have the valuation report, and it's not possible to do any comparison with we don't find any comparable data. So I will select other method as the most appropriate method, but surprisingly, this option is not there. So hopefully we'll get clarity on this from FTA in coming days, because other method is sometimes very important from an business and economic circumstances perspective, because there's no option to select the all other 5 methods. Taking an example of selecting the quotations for any commodities. So quotations are not CUP method. Those are in the form of the other method based on the business and economic circumstances. So this is just Article 35 related party schedule. We need to give the related party, name of the related party, the tax residence, and the details. And then there are certain methods we need to select. As I mentioned, there is a difference between book value and the arm's length value. If it is a difference, you need to make an adjustment. Now there's something doubt, which some confusion might be there, that what is book value and what is arm's length value. See, let's say you are providing services on a cost plus 10% basis, and you are within the range, right? And you say that, okay, I am within the range, I am at arm's length, so my book value and arm's length value would be similar. Now what happens is that the UAE TP regulations guide does not talk about the median as an arm's length. But if going by the current regulation, if you are within the range, you can consider your book value at your arm's length value. Now there might be a possibility that we need to select the aggregation up. Consider the aggregation approach, like aggregating all the transactions, related party transactions, and selecting the TNMM. So if your overall TNMM is at arm's length, you can select, you can put your book value and arm's length value is the same and select TNMM everywhere. So you can aggregate everything. So when I talk about the aggregation, it does not mean that we can aggregate all the transactions and just report one transaction. We still need to report, let's say, purchase of raw material, sale of goods, payment of royalty. If there are different transactions, we still need to disclose all the transactions separately. But when it comes to the method, it will be TNMM method only, and your book value and arm's length value would be same. Now coming to the transaction type. If the transaction type with a one related party, it's same. Let's say purchase of raw material and there are 100 entries. We don't need to separately report all 100 entries. Can aggregate and show one entry. It's all related party type and transaction type. If the related party and transaction type is the same, and even if there's a 10,000 entries, we can aggregate it. But if the transaction type are different, then we need to select the transaction or disclose the transactions separately. And in aggregation approach also, we need to disclose the transactions separately. We can take questions if there are any. So please clarify again the practical approach for connected persons. Now this is a question of benchmarking. This is a kind of a different topic. I can take it after the sessions if we get the time. But we can discuss. ESOP given to connected person, how to be disclosed. If it is a part of the compensation, it is to be disclosed as payment to the connected person. And one more thing, if you see the disclosure form, it is saying expense paid. Okay, so gross income received or expense paid. It does not mean that paid and received. Transfer pricing work on an accrual basis. So it has to be accrued in the books, while in the disclosure form, it is mentioned expense paid and income received. So it doesn't need to be like actual receivable. Even if it is an accrual, this is sufficient. So going to the other method not covered, yes, it is not covered. We'll get clarity. Whether master file and local file to be attached even if turnover below 200 million, no, not required to be attached. There's a section where you can give the reason that master file and local file not required. So one need to see not only this 200 million threshold, but overall consolidated group revenue also 3.15 billion. And then accordingly one need to see some cases, even if you are not crossing the 200 million threshold, it is important to maintain sufficient documentation. A kind of memorandum I always recommend, even if you're not crossing the 200 million threshold, you are not required to maintain local file, master file. A kind of documentation one can submit rather than submitting just plain TP disclosure form, to ensure to bring more transparency and trust with the tax authorities. Whether all transaction with related party has to be included in the disclosure form, which transaction can be excluded. See, all the transaction with the related party needs to be included. And when I say related party, the definition always we discuss, it is very broad. It is not only ownership interest but control also. So all the transaction needs to be included, provided there's some value. If there's a related party relationship, no transaction during the year needs to be included. Now, one more important point: there can be free of cost transactions, free of cost, interest-free loan. There is no section in the disclosure form to report a free of interest transaction about, let's say, interest or any free of cost transaction. But what one can do is, like, one can use this form only, and how one can report it: put the book value as a 0 and arm's length value is whatever the interest, and rest would be your adjustment. So even if there's no section, one can report in this way, which actually you can do a self adjustment in your TP disclosure form to ensure you charge interest on your loan. Okay, coming to the next question. As per law, TP documentation to be submitted upon request, and it is contradiction to the law. Yes, it is contradiction, and I was a bit surprised when I see this attachment. But yeah, I mean, if it is there, we should go by this, and we can get clarity also from the FTA on this, because law is clear that it is to be maintained. Do the transaction with tax group have to be reported on arm's length basis in this form, considering they are treated out of scope. Now, I have a separate slide for tax group, which I will go to quickly cover that whether the transaction to be disclosed or not. But broadly, if you are part of the tax group and there are transactions happening between two tax group entities, those transactions will be eliminated anyway, because we need to see end of the year. Okay, so this is very important to understand. Those need not to be reported. But interestingly, if you are doing transaction, if you are part of the tax group and you are doing transaction outside the tax group entity, related party, those needs to be disclosed here. But surprisingly, there is no discussion in the entire disclosure form about the tax group, whether transaction happening within the tax group entity or outside the group entity. So if it is outside the group entity, normal TP provisions will be applicable, even local file and other documentation would be applicable. So one need to see even so any entity who is a part of the tax group doing transaction outside the tax group, TP disclosure needs to be is applicable. Construction industry is goods or service industry. Now see, this is okay. So this is very important point. The transaction type is not about type of industry; it is type of transaction. So what we are talking about, the goods, services, intangibles, and interest, loan, liabilities is not industry type. It's a transaction type. So even if you are a construction industry, there can be goods, there can be services. You need to select the transaction type. Do we need to disclose transaction with the tax group? We already discussed. Payment made to related parties more than market value. So payment made to, I understand this connected person, right? Can we make adjustment as per benchmarking done by the related party, or we should get done separately? Now this is an important question. When it comes to the benchmarking, generally we need to select the tested party. So let's say a service provider, you are availing the services from your related party, and related party is based in Singapore. So if the related party has done the benchmarking, or you have done benchmarking considering the related party as a tested party, that benchmarking would be sufficient to justify your arm's length price, because end of the day we need to select one tested party and it can be the other related party also. So even if I'm next question, so even if I'm above 200 million and need to maintain master local file, can I choose not to upload, saying that I only need to maintain master file? See, this is this is up to you. Like, the FTA has come up with a disclosure form. It's your position to go with the law. I would still say the law is law is more important than disclosure form, and I would expect more clarity on this. But going by this form, if they're asking it, it is important to get clarity from the FTA. Within tax group, no TP requirement. I agree, if there's an elimination, no TP requirement unless you are doing outside the tax group. See, one more thing in the tax group, if the tax group, any person is leaving the tax group within 2 years, that any transaction within the tax group need to be re-evaluated. So that angle need to be seen. But other than that, if there's a formal tax group between the tax group entities, if they are transaction, all are eliminated. Should we disclose transaction in the nature of recharges also? Yes. So whatever recharge is, even if it is a cost to cost recharge, though it needs to be disclosed, and the transaction type can be considered as a other transaction, because end of the day, it is, I know it's not service which you will not charge markup, but it is a transaction between the two entities. How to declare transaction involving long running receivables and payable with related party? Now this is very important question, long running receivables and payables. Now if you have a receivables in the first year, and you have, it is a long due, you have not interest, the tax authority might ask for the notional interest from those receivable. Now in this particular question, the angle of transitional provision also comes into the picture. So there is no discussion of the transitional adjustment in the disclosure form. So if you are aware, Article 61 is talking about the transitional provision, where your closing balance should be the opening balance. And if your closing balance, let's say you have an interest-free loan at the closing, so you need to adjust your balance and show it as an opening balance. So this is important. See, charging interest on the earlier year's loan is something which is not the intent of the law. The law's intent is that your closing balance should be opening balance based on the arm's length. And how you do the arm's length? By adding interest part. Now law is not clear how long you can go back. It can be receivable for 5 years, 10 years, or 20 years. The law is not clear. So one need to take a pragmatic approach, might be 1 year, 2 year, or get clarity from the FTA, because the Article 61 is not clear. As an ambit of related party, as per the CT, wider there's a difference between related party transaction as per audited financial, and more transactions are covered in the TP disclosure form. Yeah, I mean, I think it's not a question, it's just a clarity. So please clarify again practical approach for connected person, which you told, where there are decision making will be covered as a connected person. So I will take this question later because it's a separate question, like separate topic, whether funds can be provided to related party company without charging interest. See, if you are providing fund to related party, if it is a nature of the loan, one need to charge the interest. Okay, so if you are basically providing loan to another party, one need to charge interest unless it is a capital commitment or kind of quasi equity. Interest is required. How can we access the local file and master file template? See, there is no local file and master file template. There's only the content of the local file and master file under Article 55, which you can get from the transfer pricing guide. You can create your local file template according to that Article 55. Which method we have to choose for reimbursement of expenses between related party? I'll go with the other method, because if you there's no any other method you can see, because all other methods are talking about the price comparison, profitability comparison. In reimbursement, there's no human efforts involved, there's no service element, it's a cost to cost. So it would be other method. Transaction with the related party, both are taxed at 9%. Do we disclose in the TP form? Yes, it is, disclosure is required. Even if there's a transaction between two mainland entities, the TP disclosure required, even if there's no base erosion, because if that FTA does any adjustment, it will the adjustment will be done on one entity and there will be corresponding adjustment. So from a disclosure perspective, disclosure would be required even if there's a 9% and even if there's a 0%. So there's a transaction between QFZP and QFZP, then also the disclosure will be required even if there's a 0%, because it may impact the de minimis requirement. In between QFZP, there's no transfer pricing, like every 0%. But if it is done on a non-arm's length basis, this may impact the de minimis. So these things, this de minimis, free zone, qualifying free zone is again not covered in the disclosure form, and we'll see how FTA will get, comes up with the more clarity. What is meaning of the treatment of adjustment to gain or losses in relation to assets and liability previously received from related parties at non-arm's length price? Is there any first page of disclosure form? No, when it comes to transfer pricing, there is no gain or losses we need to report for the previous year. Disclosure form is only for the current year transaction. Okay, so this needs to be keep in mind. How transfer pricing is applied to intangible assets such as trademark, patent in relation to related party transaction. Now, this is an important question. So we need to understand what kind of intangible assets it is. So there can be underlying intangible assets for which royalty can be paid. For that royalty, we need to disclose the transaction payment of royalties, select the basically IP as the transaction type. See, there can be ambiguity. Someone can select this is not IP, this is royalty for IP. So I should go with the like cup method. Okay, so sorry, I'm talking about transaction type. Transaction type would be your IP. Okay, so IP or any other transaction type. And when it comes to the method, it would be your comparable uncontrolled price method. If you have valued your IP accordingly, so you will select the cup method. Transaction between tax group disclosed or not. So we already discussed this point. The next question is, this is the point there in disclose. What will you suggest to do there? What is the meaning of treatment of adjustment to gain or loss? I think I already discussed this. So I think I have covered all the questions. Let's move on to the other part of the disclosure form, which we discussed. So related party schedule we discussed. This is the overall related party sections, where we have the transaction type, we have the methods we need to select, and amount, and the tax residence. And then there would be a summary of all the transactions and adjustment also about income and expenditure. Now, what are the key issues? I think most of these I already discussed, but to summarize, gross value reporting, like you need to disclose the gross sales. This is a kind of surprising thing for in disclosure form, but we'll get more clarity on this from the FTA, hopefully. Exempted entities, note specific discussion about the exempted entity. See, disclosure form anyway would be there, but TP documentation is not applicable. So from a TP documentation perspective, one can put a comment that I am an entity claiming small business relief, so this is not applicable. Free zone, no discussion about qualifying free zone entity, no discussion about the transaction between them or any de minimis impact, because if it is impact de minimis or if it is non-arm's length, you may lose your QFZP status. Other method, there is no option to select other method. Tax group, as I mentioned, there is no separate discussion about transaction between tax group. If there's a transaction between tax group entities, anyway, these are eliminated, but outside the tax group entities, one need to disclose it. Free of cost transaction, no separate place, but as I mentioned, one can report it by putting 0 as your book value and arm's length value and then show as an adjustment. One important point, now this is very interesting point, transaction between head office and domestic PE. So if we talk about, there's a transaction between head office and the domestic permanent establishment. Now this I am talking about from a mainland and a QFZP perspective. One entity in mainland, another entity in QFZP, 0%. Now the question is, do we need to report the transaction? Because arm's length analysis we anyway need to do, because one is 9%, another is 0%. If there is a transaction, there can be a profit shifting. The point here is that head office and the branch is considered as a one legal entity, no separate legal entity. The point I am making here is that if there's a one legal entity, the disclosure form would be filed only, because there's a part of the one legal entity only. But this is an interesting point, that even if there's a one entity, do we need, I mean, there cannot be separate legal entity for between head office and branch. So there will not be any disclosure between head office and branch, but the arm's length analysis would be needed, because there can be tax arbitrage. One is in 9%, another entity is 0%. But disclosure may not be required because both are not a separate legal entity. Again, next point, transitional provision. Transitional provisions is not specifically discussed how it will impact. Is there any I think we can get some clarity from the FTA, because in the next year opening balance and then opening balances we need to again add if there's an interest-free loan or something. Financial statement. So if we talk about the documentation requirement, there's a requirement of local file, master file, and financial statement. Now it is not clear, can we attach draft or sometime management accounts, because financial statement may not be available in all scenarios. So again, this is a point which we need more clarity. So this is all about related party schedule. Now talking about the connected person schedule, it is more or less same. There would be summary of all the transactions. You need to enter all your connected persons, payment. See, payment and the benefit. So when it comes to the benefit, let's say villa is provided, you need to add market value and value this. And your if you feel that the market value and book value are the same, then you don't need to do the adjustment. So this is the broad details which is required in the connected person schedule. I'll talk about the approach of benchmarking quickly. Now, when I talk about the connected persons, there are some observation I made. If you read the law says that first requirement is that for deduction is that it has to be wholly and exclusively for the business, and it should be at arm's length. But if you see the disclosure form is only talking about the market value and the payment value. Disclosure form is not getting confirmation that whether payment is wholly and exclusively for the business or not. Ideally, there should be confirmation whether the payment of connected person wholly and exclusively. If not, there should be adjustment. And is it whether it is arm's length or not? Arm's length is what? That your book value and the arm's length value are the same, then no need of adjustment. So this specific point is not covered in the disclosure form. Hope we'll get the clarity. And again, another point is that reporting mixed purpose. So let's say payment, a payment can be anything. It's not only about salary. It can be traveling expense for the business. So some payments are made for both business and personal use, and personal use may not be allowed, which are not for business. So one can disclose it as a book value, whatever the amount, and the arm's length value would be your 0, because your book value is this, and there would be your adjustment. Okay, so accordingly, one can disclose while there's no separate feature in the disclosure form, but one can disclose this way. You can adjust your book value and arm's length value and disclose it by way of an adjustment. So this is related party schedule, connected person schedule. Now documentation schedule. Broadly, if you see from a transfer pricing perspective, there are 3 documents: local file, master file, and the financial. We already discussed. There is a feature where you can add comment if the disclosure, the local file is not applicable. So this is the overall 3 sections of the disclosure form. Now, quickly going to the practical approach for disclosure form. So, as I mentioned, I'll not go into too much of detail, but the whole idea is that local file needs to be attached wherever it is applicable. Given by the going by the disclosure form, if you don't get the clarity from the FTA, given that the approach is that we need to identify related party transaction, we need to basically identify the connected person. The third step would be verification of those transactions. Fourth is do the functional economic benchmarking analysis. And then once we are clear about the arm's length nature of the transaction, then we should report as a book value, arm's length value adjustment would be zero. And nobody would like to do a set self adjustment, right? Unless there's some exceptional scenario where the transaction itself, entered into without looking into transfer pricing. So if you follow this standard approach of practical approach, you would be able to justify your arm's length price also with the full transparency and ensure that there's no adjustment. So this is the whole practical approach. There are some other aspect of related party disclosure, like groups similar transaction in minimum line item. As I said, one transaction, 100 entries, same transaction, same related party, you can club together and so. But if there are different transactions, nature of transactions need to show each transaction separately. Ensure alignment with the master file and local file. This is very, very important. And in terms of the method also. And I give you one interesting example. I have seen number of disclosure form, particularly in this region, where your policy is in the agreement is cost plus a 10% markup, and your disclosure form says cost plus method. Your pricing is different, your TP method is different. Your pricing can be cost plus 10% markup, but the method you will select in the TP disclosure form can be the transaction net margin method, even if your pricing is cost plus 10%. So this is very, very important. Perform arm's length analysis, advance of the disclosure form. Transaction in the foreign currency need to be carefully converted into AED. So the whole disclosure form into the AED. Now coming to quickly into the verification before we move on to the important slide of the tax group, and we'll also talk about the benchmarking. Now, disclosure form is not only about you just put the data into the disclosure form and select the method and see it is at arm's length. One need to do an entire analysis before we select the method, conclude at arm's length, and that analysis can be in the form of preparing the segment financial for related party. It can be in the form of the outstanding receivable. You need to see whether it is outstanding for a long period of time. Have you considered the closing opening balance and transitional provisions? We need to see the transaction outside the tax group. We need to see the TP policy and intercompany agreement. Are they all aligned? Benchmarking perspective, we need to see if the comparable range is not in arm's length, we can do the working capital adjustment and then accordingly conclude the arm's length pricing, because this adjustment is allowed as per law. One should take a benefit of it and ensure that proper adjustment is made. Benefit test documentation is very important. Again, you are paying royalty and you need to see whether so let's say you are paying a royalty to another company, one entity, and you determine it is at arm's length, and you concluded everything in a disclosure form. Certainly, based on the interviews and all, you find out there's no benefit only. You determine the transaction at an arm's length, but overall, there's no benefit of that royalty. So in that situation, this is a case of disallowance. Okay, so your book value might be there, your arm's length price would be different because there's no benefit only from that royalty. So verification is not only about getting the amount and data. Verification is also technically reviewing the transaction from an arm's length perspective. I'll not go into this slide. We already discussed this disclosure form. I would say a disclosure form from a risk management perspective, both for taxpayers and the tax authorities. It will definitely help in reducing your overall effort for the local file and streamlining all the related party transactions. Quickly, I'll discuss tax group. I think I get a lot of queries when it comes to the tax group, whether tax group transactions are to be recorded or not. One thing is very clear, that if the tax group is entering into a transaction with the another member of the tax group, no transfer pricing applicable, because all the transactions are eliminated. Now there is a catch here. If any member of the tax group leaves before the 2 years, then whatever the transaction entered previously, those needs to be reassessed and tax to be paid accordingly. So that to be seen when this tax member leaves. So that is the second. First scenario is outside the tax group. Second is the elimination. The third is if the member leaves the group. The fourth is transitional provisions. So when we talk about the tax group, it is very important that before we consolidate, we need to see whether the closing balances and opening balances are proper in the tax group entities, because that's where the arm's length principle may come into. Pre-consolidation losses. So if there are losses in the pre-consolidated period, let's say in 25 the tax group is formed, in 24 there are losses, and those losses are on account of the non-arm's length situation, then such losses can be carried forward but might be disallowed because you have not done the transaction on an arm's length basis. So this is very important. And the last and important point, payment to the connected person. So the question may come that what about the payment to connected person when it comes to the tax group? See, tax group, all the transaction eliminated which are happening between the entities, but when it comes to the payment to connected persons, those are not those are not eliminated, because these are might be to individuals. So before consolidation, these transactions to be looked into from an arm's length perspective, and then accordingly the consolidation to be made and overall tax liability to be identified. Now we have covered everything when it comes to the disclosure form. We can, if there's any specific question on this disclosure form, happy to discuss. Now come to the, I'll take few minutes talking about the benchmarking approach for the connected person. Now the specific questions not particularly relate to this session, but specifically because I get a lot of queries, and let me talk about it. See, payment to connected persons. Who are the connected person? Owner, director, and officer. Those needs to be at arm's length. Now, before reaching to the arm's length, those needs to be for the holding exclusively for the business. So before reaching out to the benchmarking analysis, comparing with any third party reports or so on and so forth, one need to document the functions of that particular owner or director, the roles played by that owner or director, his educational background. This is very, very important to justify. Okay, so let's say a startup CEO performing various roles. He might be a finance head, he might be a overall strategy head also, multiple functions. He cannot, his compensation cannot be compared with the SME or any listed entity or a big group, right? So startup. So it is very, very important. The first step would be to document roles, responsibility, background of the company, of the individual and the company also. Once we have the clear visibility, then we need to see that can we follow the overall aggregation approach, that even after making payment to the owner, director, or officer, my margin is at arm's length. This can be one pragmatic approach, that even after making payment to the owner, director, officer, my net profit margin is at arm's length compared to the comparable company. This can be one approach. Now, I would say this can be one approach, provided there's a proper documentation of the functions, role, responsibility. This is very, very important. So even if someone follows an aggregation T&M approach, documenting roles and responsibilities are very, very important from a transfer pricing perspective. Another approach, if you can't follow that, because there can be loss making scenario, and it does not mean that if you are loss making you cannot pay to the owner director, one can again document everything and then see, based on the job description, roles played, significant critical functions performed by that individual, is there any data which I can get from the market for the similar role? So let's say if I, as a director of a UAE company, I helped my entire group in setting operations in KSA. Now, if I help my entire group in setting operation in the KSA, you see similar profiles or similar experience, but for that you need to document everything. You see similar profiles of that CEO or whatever director, where you see the JD, where is there any such role in the market which basically asking the candidate to set up the operations in the KSA. You select that, and then you see what are the difference, and then you can make some adjustments. See, it's transfer pricing is not an exact science, and I don't see FTA will anytime will come back and clarity that it should be your compensation to owner, director, officer. This is very subjective. One can make it very appropriate only by documenting the roles and responsibilities, documenting the substance part of it. Benchmarking is the secondary part. The first part is the documenting the roles, responsibility, functions. And this is, I would say, as important as benchmarking analysis. So this is all from a connected person perspective, disclosure form perspective.